What is up, Resource Nation? I'm super excited. I got two good friends here, all on the East Coast. I'm on the West Coast, and we're gonna have a badass conversation. So Rob Pieklo is here, COO of AFR, has had many jobs in the industry, secondary, hedging, COO now. Ryan Hayes is with us, had very similar jobs throughout the industry. He's a regional director at Moving right now. Two of the smartest guys I know. And remember that old app called Clubhouse? That actually connected us together during COVID crazy times. And now we have really cool relationships. And these are two of the smartest guys I know. So I'll attempt to keep up as we have a really interesting conversation. Maybe I'll have to slow you down if you guys lose me. But guys, I'm really excited for this conversation. If you're driving, if you're at your desk, stop what you're doing, listen in, because this is going to be super intriguing. And let's get right into it. So I'll start with Rob, and then we'll go to Hayes, and then we'll just have an interesting conversation. So Rob, I'm curious, like, your perspective of the industry this year and next year. Like, what was the most surprising thing, in your opinion, that happened to the industry this year? But then also, what do you think's coming our way and maybe the most surprising thing that's going to happen to us next year?
Great question. So first, thank you. Thank you so much for the intro, and love the show, love everything about the program here, and wanted to, like, this is a flashback. I just want to talk about this being a flashback of Clubhouse back in the day. Now we're 4 years from when we started there, and it's cool to kind of one, see you guys on video versus just being on audio. But we had some crazy times with some crazy topics, and Ryan, you guys both were able to join me on the stage a bunch of times. So I want to say thank you for that, and I'm so pumped for that happened, because we get to do stuff like this. And I've been on a couple of that weird connections in our mortgage biz that we have, but from Clubhouse, been on a couple of podcasts, and it's amazing to see where everybody has kind of gone since those shows back in the day. Talking to guys from Treasury and talking to guys that run big parts of the business. So amazing stuff. So quick, back to your question. 2024, I'll be honest, I would say the most surprising thing in my world, because I'm a little bit more in the wholesale channel, in my world, was kind of the kind of Hunter Brook, kind of the media thing coming out and like really showing the resilience of the number one lender in America, which is tough because they're a big competitor of mine. But watching and seeing this huge thing, you think it's going to blow up everything, and kind of heads down, continued down with the business, and saw that it was kind of like just a small bump in the road for the channel and for the number one lender in the country. So it was an interesting thing to come up. We thought it was going to be a bigger deal, and we kind of just pushed through and forged ahead, and it turned out to be, like I said, nothing in terms of the industry, just a small speed bump. And 2025 is kind of coupled with 2024, and it's really a shift and a little bit of a surprise of what we saw from the election for me, and thinking, like, we have a lot of things moving. There's a lot of moving parts. We're going to get into that, I'm sure. But it was a little bit of a surprise at the time. I know maybe some people don't think that. We're not going to get into politics here, but it was a little bit of a surprise, I think, for some, especially in the industry. I would say from DC's perspective and from the agency's perspective, a little bit of a shocker of a complete shift of what potentially all the people that back our loans and insure our loans, what the philosophy is going to be. So going from lots of affordable, more programs, to then start talking about things like shrinking the GSEs and getting them smaller and switched over potentially to a private market.
Yeah, and if you back up to the election, you can kind of see that start getting priced in a few weeks before. You're like, what's going on? And like, people started figuring out what was about to happen before it happened. So that was really interesting to me.
No, I think it's, my 2024 is a cliche to say the market, right? And it has so much to do with the election as well. I think for people like Rob and Ryan, like you and I, we feel like we get a pretty good idea of what's going on. We've got a pretty good idea of certain market moves and what that's going to mean towards Treasury prices and MBS prices. And I think it put us sort of on our backs a number of times this year. Just the volatility, the paradoxical reactions between geopolitical stuff, which normally does this to the market, now it's doing the opposite. Mixing in the election, which so many people had so many different views of what was going to happen, but then also the actual election results, and then some people thinking, okay, that's good or bad for the bond market. So I think the market itself, right, it reminds me of the saying that is, the market can remain irrational longer than you can remain liquid. I think that was probably
Yeah.
the biggest shock of 2024 and sort of putting a lot of people on their heels. And I think in 2025, we could continue to see that. I think it's also still connected to what's going on in the government. Could we potentially see more private money continue to flow into the business? Could we potentially, get into real talks about conservatorship going away for Fannie and Freddie? What does that look like? What's the next steps for the market? So I think all of it is sort of tied together in the market with the election and all of that. But really the surprise is just the volatility and really how sort of it took us back in a lot of different ways.
We'll get into private money and conservatorship for sure, because I think that's super interesting and one of the many variables that we will get to watch unfold next year and in the next 4 years. Comments on, like, I don't know if you guys got a chance to see last week's show. I think it's fascinating what's happening with the cabinet. I don't want to get into politics either, Rob, but like, I've got my popcorn out. Elon's talking about possibly getting rid of the CFPB. And, the cost saving measures, which I'm a fan of, like if we can eliminate some cost and become more efficient as an organization, as a company, as a nation, I'm for that, right? So do you guys think that actually can happen? Thoughts on, do you think we can actually eliminate the CFPB? Do you think it's duplicative? And do you think there can be a material impact on mortgage rates if Elon kind of executes what he's talking about?
Who
wants to go first
I would
on
say,
that one?
right, just touching a little bit on the CFPB piece, right, is look, the CFPB has a mission that was, like a lot of these things, born out of real issues that came from the industry. But the way that it's been run and the way that they've done, basically rule through enforcement and all of that have been really, really challenging for our business. It's created an immense amount of cost inside of our business that's just, it takes its toll on the customer.
That gets passed to the
Exactly.
consumer, by the
And
way.
that's the biggest thing, right? Like the CFPB has placed, because of a lot of these regulations, not that the regulations are bad, but the way that they're enforced and the way that then we have to prove to the agencies in our audits, has put a lot of cost in this business, and it's going right to the consumer. So I do think that there is a lot of good to come out of, a reshaping of how that is done.
I think it's ironic that three mortgage guys are talking about efficiencies, because we know the industry and we know what we are like comparatively to other industries. Like, we're not there, right? But it's a good point. And on CFPB portion of this, it's interesting to see the discussion points and how they enforce, and so much confusion. There was a post on LinkedIn that I commented on the other day, and it's just funny because the way they've enforced, the way they have the rules set, like, and how it started versus how it is today, it's very odd. You'll see this post mentioned about a compensation structure that is like clearly against the rules, clearly against what was the kind of intention of the rules. But at this point in the game, it's like years and years later, these things have morphed and evolved, and it's created this weird, like, kind of proxy, we'll say, for those that don't follow the rules. It's way easier to do business, way easier to recruit, way easier. Like, when you try to do things right, it's difficult, and it goes down to confusion around enforcement and not getting clarification on certain things. And you think it's in there, you read it one way, and then you look, and if you go out in the market today, we use that little comp as an example, like something so simple. And if you go from the broker channel to the retail channel to company, everybody does it differently. And one person's going to say, one compliance officer going to say, like, that's actually illegal. There's no way we can do that. And meanwhile, they're turning around saying that's illegal of what they're doing. So it's a very odd scenario. And it's unfortunate because, the cost of the oversight of doing things right, it's so expensive to do it right. And so much checking and so much, rechecking, and having issues with loans and having issues with compensation, like, all of that costs money. And so if you just don't care, you have a competitive advantage, which is not the spirit of the rule.
Well, and right shouldn't be a relative term, like you're saying.
And by channel and by originator, like, to me, I'm like, where the loan, like, the originator is the star of the show all the time, right? The last mile of origination, doesn't matter what channel you're on, like, that means everything. That's where the loan comes in. Like, that part of it, how could there be so much confusion and change based on what happens after they originate and who they decide to sell to or originate through? Like, why would it be completely different on how an APR is calculated? if the net dollars are exactly the same. It just makes no sense. So when you kind of take a look at it, you kind of, it just raises, a lot of questions as to what's the point. This is just our segment of the business. This is just one portion of it. This is lending as a whole, and anything regarding to finance and any type of lending. So like, there's more to it. So if it's that way in our industry, I'm sure it's that way in other industries as well, in other segments of the business. So yeah, it makes a ton of sense that the states can have control, can have their rules. We can do that. It was nice to have a baseline to use because a lot of states use them. We know some states went above and beyond what the initial rules are, even in basic like income calculations through Appendix Q and whatnot. So like that part of it, it could, like, it's good to have the baseline. Maybe there's some shell of that still there, but the rules and how it's enforced and how this last few years has been based on a complete deterioration of what we thought was right or what was wrong, and that has completely changed, and we need to kind of get back in line to have the same level playing field for everybody.
I mean, different regulators from the same agency come up with different outcomes. It's really, really hard to play in a playing field when nobody really knows the rules. When you can look across the street and see a competitor doing something after they've gone through an audit, which has been passed, and then you get an audit and the same thing gets questioned, right? Like that is a really tough playing field to play on. So I think.
And the other regulators aren't even talking to each other. You mentioned the states, Rob. The states have their own regulators as well that catch a lot. And before you throw pitchforks at us, like I'll speak for Rob, and I don't usually do this, and for Hayes, like we are all for doing the business the right way and consumer protection in a compliant way. So don't get it twisted. But there's a lot of overlap, and that could be done in a more efficient manner and pass the savings.
Yeah, and I mean, look, like ability to repay, right? That's the tenet. Right? We've moved so far beyond ability to repay. We've, the people putting some of these rules and regulations together, right? Like, don't think of things like residual income. Don't think of things like new ways. I mean, we've got shared appreciation. We got all of these, really cool, new, innovative tools that could be used to help homeownership, to help build generational wealth. And because we have so much regulatory oversight, it just stifles innovation in a way that you just don't see, right? Like there's no electric car of the mortgage business, right? Like there is no Elon Musk of the mortgage business right now because of the amount of regulatory rules that we've got to go through.
Ability to repay.
I've always wondered that though.
Yeah, I was just saying the ability to repay. I just want to just because it's funny. I love saying it. The one aspect of ability to repay that isn't accounted for is the borrower's actual ability to pay and history of repayment.
Yes.
Has no bearing on whether or not they have the ability to repay. The fact that they've paid things forever and have money. It's about the calculations that are going forward only, and not the fact, we always joke about the DTI scenario. If there wasn't a GSE kind of overlay and saying like, of back in the day when they said 43 was the line. So 44 debt to income with 100,000 in the bank is way worse than, $1 in the bank and 43 debt to income ratio.
We used to always say that, right? Like if your car breaks down, you still got to pay $500 to fix your car. So who's going to be in a better position, right? DTI never took that into effect.
Exactly right.
Well, 43, ratio on a guy that makes $100,000 a month and he's still got, 50 grand left over isn't that big of a concern to the guy that makes $3,000 a month. And I love residual. I wish we would leverage that more. But you were talking about Elon, and I've always thought, and I don't know if you guys have thought this way too. So the three of us are products of a mortgage environment. I think you served on the MBA for some time, Hayes. And so we probably think the way that we were kind of born and built in this business through a lens of, you originate a loan, fulfillment, securitized. So it might be hard for us to think outside that lens. You mentioned Elon, and I've always thought like, man, what if a guy like that came in and had none of our preconceived notions of what the mortgage industry would look like, had to start from scratch? I'm genuinely curious, like, what would it actually look like? What would the innovation be versus this is a 50, 60, 70, 100-year-old business, still kind of do it in a relatively the same way. And sure, there's like new stuff like non-QM and SSV, but I just wonder like what a guy like Elon would.
And today, that's an interesting comment because like we've had that, right? I've had a bunch of pitches in my career here, in different roles. I've been able to hear a lot of investment decks have crossed my desk, and love seeing the, I could literally have looked at 10 or 12, more than fingers, but not toes, but 10 or 12 folks that did a mortgage to buy a house and couldn't believe the process was so bad, so they're going to change it. And then they get a bunch of money, which is amazing because they're really good at raising capital. And they either lose it all, go out of business, or lose it all, raise more, lose it all, raise more, lose it all, raise more. So they haven't been able to find the trick just yet. And it just comes to the fact that there are antiquated pieces to the business that are required. So when real estate turns digital, it's going to change that last mile. Customer acquisition, to do everything right, that's the piece that people forget about. It's like you can figure out a way to do it, get the customer in. And then if the business is still handled by last mile realtors and dealing with that and referrals, you still lose about half of those people no matter what. So then all of a sudden you're staring at, $3,000 or $4,000 cost of acquisition. And all of a sudden you're not like the best price anymore. Then all of a sudden, and you kind of just teeter on this. Everyone thinks you're going to walk in, be an online portal and kill it. I tried that too. I messed up. I was a little early, 2016. We tried to go that route, and I discounted the kind of last mile origination and how much influence local people have, and then you lose that. So that's not there yet. But the manufacturing process is just hindered by GSEs, by title, by these small things along the way in the process. And to be honest, our industry is staring at the conference, and it was ironic. I was at this AI portion of the MBA in Denver, and we're talking through it. This is amazing, and this is what we have, like AI this, AI that. And I'm staring around the room of a bunch of, and I can say that now because I'm one of the old guys, a bunch of the kind of blue hairs out there that are in their blue sports coats, staring up the thing and never even talked to Chat GPT, like nodding their head, like this is where we're going. Yeah. And meanwhile, 70% of the room can't have two users in a loan file at the same time. Like it's 2024, but that's the pathway we've gone. I was going to get there. I knew I was going to get there. But we'll just say,
fintech is so uncool, right? Like, can't we just try to attract like the real technology people? Fintech, in more specifically mortgage tech, has just been, so uncool and just an untapped spot. And even the people that have tried to sort of tap it have created some really tricky environments to operate in.
Yeah, and the time.
Well, is the innovation stifled, guys, because Rob said they're Fannie and Freddie are still in conservatorship? Does that have any impact on that? Will they come out of it? Will we see more innovation if they do, or is it all just about private money coming in, kind of writing their own rules?
Yeah, it's rules and regs. It's a combination of it all. I think of what we have. We have we're behind. In technology, we know that. Everybody knows that. We talk about it quite a bit ad nauseum, and most of the function and money spent over the last 10 years in innovation has been focused on things that really don't matter. Like we focus so much time on, instead of thinking about the experience, we're focusing on like how do we draw in passwords instead of like an actual document or pay stub, and like spent so much time, money, and kind of wastefulness of something that's going to be going away. Like we know we're going to an era, like a time or an era where you're kind of like a walking wallet, and like everything about you is going to be right there on your phone, where your credit stands, the income you have, what you're making, what you have. Like it's going to be just a profile, and like that's how this is going to like evolve. It's going to be this proactive nature of technology telling you you're ready to do the things that you need to do, versus it being reactive and then deciding and finding out whether you can do it or not. Like that's the shift that we have. We're currently all reactive, no matter what anybody says. The only time someone applies for a mortgage is when they want to buy a house, versus your profile and like everything about you saying, bing, by the way, it is optimal right now for you to go out. You can do it. You can go buy a house right now. And we're not doing that portion of it. It's very reactive in nature. So like once that shifts and changes, then you can start to see some real money pour in, and the regulations and using the GSEs and really, HUD, we'll call that, it's a big portion, big market share piece. It's like those things, we're not prepared to go down the path with the government agency. So as private money comes in, yes, you have to, that portion is most likely going to change, but you should think about it as you're kind of like, you talk about AI lending and kind of structure of whether someone can pay or not. We got to kind of remove that from the guidelines and these thousands of pages of just antiquated, a source of $2,000 here, and you can't use Bitcoin, and you can't do this. Like got to remove all of that. So that has to happen for us to get a true engine of a black box of AI determining whether or not you can make a payment, and having the underwrite live there, because the computers and that portion is going to be way smarter than any human, in the next few years as you get more and more data into the system.
And look, we're still suffering from the investors that really got hurt in the turndown, right? I mean, a lot of those rules and things were put in place so that investors felt more comfortable in buying, bonds that are backed by this asset. And, as we sort of get outside of that traditional structure, Rob, like, I think that's where you can start to see that piece, right? Like, if you could come up and say, hey, we're going to securitize a pool of loans and we're going to pay you, a dividend on that. And here now is this new way where we're looking and being able to judge risk and make sure that these people can pay and make sure that the collateral works, sort of outside of that framework that was really sort of hammered in post, financial meltdown. I think that's where, like you were saying, that's where we're going to see some really big innovation take place.
Yeah, it's not when you pay; it's about when you don't.
Right.
So that's the difference. So like the rules and the regulations are put in place, and then separately, like how do you like regain the collateral? Like that's part of it. Like that's when people want to lend, like these rules around owner occupied versus investment, and these rules of how things work and how you can get a home or the collateral of what you lend on. Those things have to have some significant changes, or have to be allowed to be priced accordingly. It's not a fair level playing field. It has to be risk, and the higher the risk, the higher the cost. And that's just how it works with regular.
Well, and thankfully, our default rates are still, you make a good point. It's not about when you pay, but if you don't, I mean, those default rates are still incredibly low, yet drive a lot of the decision making in our business. One of the biggest, like there's a lot of positives. We're talking a lot about AI and how it affects ops and fulfillment. In my opinion, one of the biggest pickups, I'm curious your guys' thoughts on this, pickups that also, I love you loan officers, I'm one of you, but this is something we need to be aware of. In my opinion, AI and the ability to work a servicing book is going to be massive. And guess what AI doesn't do? They don't get tired, they don't have call reluctance, and they have predictive analytics. To me, I share this with my loan officer friends because, guys, those are your customers, I understand, but sometimes we don't work it as good as, say, an AI strategy could. And so to me, that is a real big positive for people that own those servicing books, but also kind of a bit of a warning shot to the loan officers that maybe aren't working as hard to retain that business, because runoff's still a major problem in the industry. So to me, it's a positive and a negative. Thoughts on that?
Yeah, if you don't mind, I'd love to jump in, Ryan.
Yeah,
sorry,
go ahead.
It's so cool because I just lived this, right? So I just sold my house, and I ordered a payoff, and I got the call. It was hilarious. I got the call from my servicer, like, oh, what's going on? Trying to figure out if there's an opportunity for refinancing or purchasing, which they didn't quite know. And it was so interesting because I was talking through it with them, and I pretended like I was going to refinance and went through it, and they asked some questions, and I just played along, and it's like, sorry, like we can't do anything because of the second lien. We have a second lien on this, and it's not going to work exactly how it was. Now, mind you, the thing has been paid off and is gone, but there was a second lien in the past, and I was talking to him, and he didn't know the guideline. And I said, and I kind of knew the guidelines. I said, well, the CLTV, it does work, so I just want to do it this way. And he's like, no, like this, we're not able to do it. And then he kind of just gave up, right? You could tell it was just one of those calls. It was just a bad day, and whatever it might be. And he gave up on it. I go, thinking about that, like AI is not going to not know the guideline. AI is not going to know. So when you drive the eligibility and then have the initial, conversation, or have that initial, and now especially with what's happening with AI and voice, kind of have a whole conversation, and you still need that licensed kind of entity or person to do the loan. But how do they help not have like human error in the calculations of what's being done, and have somebody who had clearly like just gave up, probably new salesperson, guessing based on the company that I was talking to and I know very well. So, when, and you're like, holy cow, like this is where the use case makes so much sense there. And then I have one more point on the MSR thing that I definitely want to touch on after, but I'll let Ryan jump in. on this
No,
one?
I think if, Ryan, if people are out there not thinking that large servicers are implementing a massive amount of tools right now to get to, I mean, I talked with one of the largest retail bank presence, right? And they know what time to call customers, right? They know what day to call customers in which they pick up the phone the best. There's a lot of data out there that they are utilizing. I think the biggest thing for us is, customer acquisition and that sort of real relationship piece of customer acquisition. I think there is always going to be a spot for that, but you really have to position yourself as a financial manager, as a debt manager for this customer, as a financial planner for this customer. They have to call you when they're thinking about making any type of financial transaction. And what so often happens is you close a transaction, they've had this incredible experience, you put them in the house of their dreams, you've set them off on this path of generational wealth, and then what happens? You never talk to them again. It's incredible. So, we really push hard to make sure that people are one, have the tools to go about and make sure that they're staying in touch with their book, but think of themselves differently nowadays, right? Not as a loan originator, but as a debt manager for somebody, because I think that's the way to stay relevant, and that's the key to continue to be successful going forward.
Rob, I want to hear your MSR point, but you made two. One, you validated my point, so thank you. Two, you also highlighted, I don't know if you meant to, an opportunity for loan officers to outwork and outthink AI in the moment. And it may get better in the future, but had maybe a better loan officer, no offense to that guy, had the ability to maybe critical think a little bit quicker, maybe they would have been able to, find an opportunity there. So that's interesting to me. Again, back to the lack of our innovation in our business, it cracks me up that we think we're cool because we got a trigger lead. Yeah, we're good. We're doing good. We got a trigger lead. So I'm going to call Rob and go, hey, looks like you're selling or refining. And I joke at that because it's already here, but it's only going to get better. Trigger leads aren't that cool. Predictive analytics will see that Rob's exhibiting behaviors weeks before this is going to happen and reach out way before the reactive trigger happens of it's kind of already too late. I'm paying this thing off. So kind of two interesting points on that. But what were you going to say
So
about
the MSR piece, and you can see it. And so if I didn't want to do like a more drama-filled 2024 point with what I mentioned, so if I didn't want to do that, I would say it was the year of MSR ranges. It's the year of MSR and the change of philosophy in MSR. So for the first time, you're seeing people put value in recapture. People had always in the back, had some value of recapture, but in terms of fair value of what an MSR is and how we book it, for the first time ever, people are now saying, I got the customer in, great. I anticipate receiving this amount of revenue in the future. Therefore, my value of the servicing right is blank. And being able to explain it that way and show historical, recapture rates. And we see all the stuff from the public companies talking about their recapture and touting their percentages. But that's the focus. And this year, there was such a wide range of where MSRs were marked, who marked what at what level, who was, bidding really, really hard on stuff. We were seeing six plus multiples on stuff, which is super, super high in our space. Other people, are marking things at a 4x. And these other people are marking it at 3 and change. It was just such a wide range on the same asset. And it's just a different philosophy. So for the first time, these things that we're talking about and all the work that some of these larger servicers have done in terms of, acquiring a customer and then keeping that customer, it's in their numbers and it's in the value of that MSR, which is why they were able to bid so much for it. So it was the first time that happened in the year. It was so odd to see, some of our friends in the industry at other larger institutions going like, what is going on? Like I'm looking at, trying to price here and these guys are, 75 basis points better than me. How's that possible? I have no margin in. And that's what we're looking at. We're looking at this crazy change in how people value MSRs. And that range was so wide from lenders that are doing the same thing, creating the same asset. It's just,
I think they're really confident too about the future ability to keep them in the ecosystem too with a lot of the innovation we're talking about.
You think, yeah.
And so they think a little bit, maybe, you know what I mean? Like you'd think you'd be able to keep them in. Again, that is going to be, and then sorry, realtors and consumers that are watching, I know we're getting a bit nerdy. You can grab a loan officer and hopefully help them translate some of this stuff because it really is interesting and indicative to where the
well,
business is
let me
going.
bring it down, Ryan, a little bit down to the street. to the street level,
translate
right?
for the consumer and realtor.
There has never been a time period in our industry where you can get two quotes from seemingly a lender who always has pricing very similar to each other and see a massive difference in rate, right? It just happened more this year for a lot of different reasons. Mortgage servicing rights being one of them, right? How companies are valuing that, what the actual execution of the selling of the loans of that company is, what the compensation of that loan officer is, and how does that go into it, what the financial position of that company is, and whether they're willing to do loans really skinny or trying to do more.
Great point.
Right? Like, we have never seen street rates seemingly from, two IMBs who have generally the same rates can vary in such a way, right? And then once you start throwing in small banks, credit unions, IMBs, brokers, right? It was all over the map. You'd see straight rate quotes.
There's no more apples to apples anymore,
No,
it seems like. It's so hard to really compare.
that is a really unique thing to this year that I think we've all been challenged with.
Do you guys think that settles out next year at all, or is it still going to be more of the same?
No, I think I think there's opportunities, and think there's going to be even more based on what we've seen over the last even few days. And I texted you about it a little bit, and like this new, even Fannie and Freddie coming out with a pilot program that allows them to choose winners and losers. So like, we're going to pick some lenders and run these pilot programs, and they did that in some of the affordable things that they've done in the past. You're working with big companies, have an opportunity to do certain things. And meanwhile, the mandate from FHFA, who oversee the GSEs, is to have parity between lenders. So even a small guy like me, if we're doing $200, $300 million a month of business, we can compete with those. And they used to do it with what's called G fees, and now they're doing it with these programs. So they brought this parity there. Now you have the number one lender in the country has an opportunity to not charge title insurance on refinances. And another lender who I have no idea got into the program, based on the history of the company. I'm in like shock, but they're allowed to get into this program. We have two people that now have a huge advantage against other people in terms of refinances. So there's picking winners and losers, and that's happening. So you will see some differences. And then on top of the calculations on how stuff's done, on top of all that's happening in capital markets with spec trading and all this other stuff that we don't have to get into today, and then the mortgage servicing right values, all this stuff combined, it's not going to slow down. It's probably going to get even worse and more transparent, or more, a wider range from lender to lender in there, because that one thing that we haven't talked about is the dissipation of premium. Like, we've lost premium. Right. So one point I make on every call I do with regards to capital markets is in 2021, the worst you can do on a Ginnie Mae security. So the worst you can do on a loan, the par rate was paying 3.5%. And today, the best you can do is like 2%. So the highest coupon and the highest price you can get on a coupon in a standard Ginnie MBS is 2%, versus the worst you can do was 3.5% back in the day. So like, what a difference it's made. And that change in premium has created more opportunity and more things to get value out of loans that we haven't seen before. So there's more and more stories, more and more things we have to work on how we package our loans. Therefore, you'll see a wider range on what people are offering.
Yeah, it's definitely getting to be more sophisticated, right? In all sorts of different ways. And hopefully, right, honestly, hopefully things like this title insurance program start to spark that conversation about, really, is Fannie and Freddie doing what their mission is, right? And really, there was a big pushback, like you talked about, Rob, with the guarantee fee and making sure it was a level playing field. And now we're going at it in a different way with just, these specialized programs.
Well, give us the short version on, because I read the Housing Wire article. That's all I really know about the title program. So you can give us the short version, Rob. But usually, isn't the narrative as to why, you make a good point, it's kind of an unfair treatment, and they pick winners and losers. But wouldn't they say, well, we're doing that, Rob, to proof concept for the industry, and then we'll roll it out to everybody else? So I'll let you comment on both those.
They usually do. So then allow every tier of lender into the game, not just two of the biggest. And if there's others behind the scenes, maybe, but having...
Because they use that as a competitive advantage.
100%. So if I said today that, company A and company B one company has $1,800 worth of title charges and company B has zero, and they have the same rate, same program. Like, which one are you going to go with?
Yep.
Yeah.
Unfair
So
advantage there, yep.
that part of it is unfair, and not to always talk about fair. I'm fine with there being opportunity, but it's kind of like all the loans have to go there. It's not like we have this other avenue to go. I'm not like the FICO CEO who's like, just use a different way to do credit. It's totally fine. We're charging what we have. Just go to the private market. We only work with the GSEs and the HUD for those programs. They follow our credit scores. So just go to the private market. There's choice, and you're like, come on, man, that's like 90% of the business. So, that part of it is there. And it's, like I said, it's just frustrating because they have other programs too, and affordable programs and the, special purpose credit programs too. Like there's all these things that are being rolled out, and I've raised my hand and want to do them and just be like, sorry, it's pilot only. Like you guys can't do it, or you can't do this. So it's like, It just creates these small boxes of opportunity for other companies. And it's just another thing that, that creates that spread from what people are offering.
One thing I wanted to get your guys' take on, and we've had a lot of great discussion so far, guys. I really want to have like a second and third one. Maybe we can even do a reoccurring version of this because it's so interesting to me. I hope the audience is finding it interesting. But again, there's a lot of variables. We talked about a lot of them today, pushing into 2025. MBA, I haven't seen their updated projections yet, but they're thinking, total at-bats opportunities for all of us are about 1.7 trillion this year, increasing to 2.1 trillion next year. They haven't updated it post-election though, so it could be better. Some of the rate talks that were basically all but foregone conclusions are being walked back now. So nobody knows. It's been so hard to predict the rates and the markets and volumes. It's been very humbling for those of us that try to do that every once in a while. But that being said, best thoughts on volume next year. Is it going to be more of the same this year? Is it going to be better than what we're anticipating? We won't hold you to it. We're not going to push you out. Just kind of us guys talking. What do you think?
Ryan clearly wants me to go first. So I'll step on the.
Yeah, he's like,
I don't know if he's frozen or not.
No one will remember what I say after you, Rob. Right? Yeah, that's what we're gonna.
He looked like he was frozen for a second.
So there you go. You're back. It was funny. You weren't moving, so it was literally a still, and I was laughing, going like, "Boy, he is very stoic." So in my case, do I want to do what's great for originators? Or I want to tell what I really think? So I'll say what I really think. I think we stay slightly elevated. I think we're going to have a less than a sub $2 trillion market next year, barring something, catastrophic. So if you kind of look at what the policies are, yes, government efficiencies, amazing. But that's like the only non-inflationary piece to what we're going to be doing next year with the new administration. So do I think, we have a very robust, mortgage market? I don't. I think we'll be sub 2. I think, we'll be prepping though and creating an environment that will be good for 2026 and 2027. I do think that's going to happen. And if there is a push, my major concerns with the administration is kind of what started to occur last time around when Calabria's in FHFA. We start to do these kind of pushes for higher price to get private money into the game. How do we get the GSEs out of conservatorship, which I don't think is going to happen. However, I do see some action items to show like they are trying, and that just causes short-term pain. And that's what's going to happen at the beginning of the administration. That's going to happen, early on. We'll see some changes. They try to do. We all lived through the second home and investment property changes, both from a percentage of delivery to now much larger LLPAs, and trying to, the idea of Fannie and Freddie subsidizing someone's, second, third, and fifth home. It makes sense. They shouldn't be involved in that. But with those costs, it subsidizes some other areas. Now, that is one area in the business that you've seen the private markets come in, and you can, my company itself, we have very, very good investment pricing because I'm choosing to go different routes. And we're finally starting to see the money come in and say, hey, this is pretty heavy handed for things that aren't going delinquent. And you're starting to see a little bit of that. So as that has started on a small scale, what does the new leader of FHFA decide? And how do we push? And what does it look like going forward? And where are they going to start adding more and more costs to then get private money into the space? So that's the concern that I have for 2025 as that starts to unfold. That's just going to be, you have to do one thing first, and that is going to be take the hits first and then the private money comes in to see if it makes sense from a yield perspective on their side.
This is why we agreed so much on Clubhouse back in COVID when we were talking about calls and everything going on. But I totally agree with you, Rob. I think I'm in sort of the same place. I think the one thing that I will provide a little bit is I will provide a little bit of that hope on the originator side, right? Which is I think we are still seeing a shrinking market on the originator side for those that are doing things the right way, for those that are putting in place the methods to stay in touch with your customers. For those professional loan officers, there's going to be more opportunity even in a flat market. And I do think that we are moving in that direction. We are seeing more of that barbell, right? The loan officers that took a step this year growing their business year over year are going to continue to do that because those are the types of activities that are going to make them successful. So I do think with some of the consolidation, with some of the continued relinquishment of licenses, even just some of the call center and pieces that just are not as successful in these types of environments going away, I do think that professional loan officer who's doing the right thing has the ability, even in a flat market, to actually go year over year up on their volume with some opportunity there.
I love that, and I think that part of it it's the line I use all the time is you'll never see a better time of when ounces of effort provide pounds of results, and you'll see that right now is the case, and it's not today. We're not talking about today, but the ounces of effort today and the pounds of results will be tomorrow and in the future. And I 100% agree because the medium level originator has they can go two directions, and one is to kind of do the activities and do things you need to do, or not, and kind of succumb to those that are doing the activities. And a lot of them relied on real estate agents that were like okay, and a lot of okay real estate agents are no longer doing that. Right, they're not in business. So that part of it's there, but you're right. For the originators that want to put the work in, those numbers are staggering on how much they've shrunk in terms of the total pool of who can do a loan, and who's eligible to do a loan, and who's actually done a loan. I've seen a couple of those slides cross in different presentations, and you're like, oh my goodness, not that many licensed originators have actually closed a loan in the last 3 months, the last 6 months, last 12 months. If you start to look at the numbers, and you do see that opportunity, even in a slightly down or flat market as a whole. My favorite thing to do is go on Zillow, right, and take your area. If you're a local originator, take your area, like whatever zip code you have, do like a 10-mile radius, and then hit sold in the last 90 days, and tell me you don't have opportunity. Tell me you don't have it. It's right there, right in front of you. I had like 3,000 transactions within 10 miles of my house, in 90 days, and you're like, I couldn't get 5 of those a month and 6 of those a month more. Like I can go out and get it. So it's.
Think about how many orphan clients there are out there now, just with loan officers that are no longer in the business, companies that are no longer in the business, right? Like there are a lot of people out there who had somebody, whether it's either on the realtor side or the lender side, who's not in this business anymore, right? Those people need to be adopted, and loan officers who are taking that tact, right, are really coming out ahead right now because there is a lot of need, and just nobody even servicing them. Don't let that servicer, right? Like that servicer is still not to the point yet where the professional loan originator is in terms of knowledge and all that. So that's where I see a huge opportunity.
And I want to wrap with words of encouragement. I'll give you guys a few seconds to think about it. And it kind of for me, it's what Rob just said, an opportunity. And I don't want to be an echo chamber. I think the prevailing forecast for most people is what Rob and Hayes said. It's probably going to be a similar but better year, whether it's 2 trillion, 2.1. I kind of think it might be a little bit better. I'm really excited to see some of the updated forecasts. Maybe it's 2.2, 2.3 trillion. My words of encouragement, though, no matter what, it seems like there's going to be a lot more opportunity this year. Tens of thousands, if not hundreds of thousands of more transactions will be held both on refinance and purchase transactions, and that's great news for realtors and great news for loan officers. I love the ounces of effort. I love that are putting in ounces of efforts, pounds of results. So to me, guys, that's the great news. A lot more at-bats, a lot more opportunities in 2025, and that's my words of encouragement. How about you, Rob?
It's the same thing. I think, here's an opportunity to really distinguish yourself and show what you can do from an origination standpoint. And I think You see the activities, you see the effort, and you see the results in that. So like, don't let the macro get in the way of your micro. Like it is, I'm the nerd. Let me look at the macro stuff and deal with rates and do this other stuff. You have no control of any of it. I have no control of it, but I'm going to complain and talk about it all the time. But don't let that whole macro piece and where rates are and what's happening, like focus in on the community, focus in on the person who's looking to get that next home. Look at and it sounds simple, but people can get inundated in staring at MBS screens and looking at the stuff going up and down and talking about where, pricing is, the borrower, and they're not going to look at MBS and changes and spec pool gains and MSR values. Like they're looking at like Main Street and want to buy the house at that moment in time. So don't get too caught up on the things that you can't control. So control the controllables. That's your activities. If you focus in on that, and then you want to spread worry and doubt and concern, that will show in your business. So you have to, accomplish the goal,
100%.
and this is it. So like focus in on the micro consistently. Know the macro, know your stuff, because you are an expert. But don't sit there and focus on all day long and worry about, the 3 ticks a 6 coupon moved. Like nobody cares in the big scheme of things. This is about, micro and handle your community.
That's
Yeah.
so good,
And,
man.
just doubling down on what both of you guys said, right? Like just focusing on the actions, right? Like make sure that it's the actions, not the transactions, that determine whether you feel like you're being successful or not. I know it's a hard sort of shift to take because everybody looks at like, well, how many units did I close? How much volume did I close, right? Focusing on those transactions right now can be super frustrating, and especially in markets and down markets and flat markets. Just focus on those actions, right? If you can make sure you're deriving your success from going out and making those calls, getting in with past customers, going to do your face-to-face meetings, learning new products, all of that sort of stuff, the transactions are going to follow, right? And so hopefully that, along with, I would just say, Rob, you make such a good point, right? Like the people are focused on Main Street, right? Like they want to get into their home. Make it about their home. Make it about what their goals are. Make it about what the customer, the rate, right, is something that's off to the side. These people want to get in a house for a reason, right? Their family's growing. They're moving. They want to get into a school system. All of that. If you can focus on that stuff with customers, right, it's gonna be a lot more, not just fiscally rewarding, but like personally rewarding as well.
Mm-hmm. Rob, you make such a good point, a nuanced point about, look, we're all 3 mortgage nerds. We love to learn. But we saw a lot of that this year, and I get it, as things were challenging for all the reasons we talked about today. The LO would spend a lot of time, maybe even the realtor, on understanding why it happened. And you should, Rob, like you said, you should understand your product. But it's a trap, guys. You should understand your product so that, because you're, you know what I mean? You're not trading, you're not hedging. You're a salesperson. You have to understand so that you can leverage that knowledge to go get you another listing, another sold home, another refi, another transaction. So we saw that a lot of people fall into that trap this year. You're not getting paid on your understanding until you leverage it. That's such a great point, Rob. Guys, thank you so much. Like, I know we got nerdy for the consumers and the realtors. Again, grab a loan officer, rewatch it again, pause it, ask them questions, because I think there was a lot of gold in this. And I'm so excited that you guys came on. I'm thankful that you took time with us. And I'd love to have you on again. So thank you so much.
Awesome.
Fantastic, Ryan. Thank you.
Thank you, guys. Appreciate you.
All right. We'll do it again. We'll see you guys next week.